Hello, everyone. It's Tuesday, September 20th. Today on the Final Bar, we'll be chatting with Samantha LaDuc from LaDuc Trading. We'll talk about this choppy market environment, netting out to more of a negative risk-on feel going into tomorrow's key Fed meeting. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny but smoky Redmond, Washington. Thanks for joining us every weekday after the close as we make sense of these markets using the power of technical analysis. The technical toolkit is designed to help us interpret the message that's given back to us from the markets themselves, right? A lot of analysis, a lot of financial analysis, macroeconomic analysis is educated guesswork, right? It's trying to anticipate what others are anticipating. Technical analysis, while certainly having a predictive nature to it, is really about analyzing price data. It's analyzing fact. It's analyzing what has happened and using that information to project what's coming next. And there's a lot of information embedded in stock and ETF prices. We'll cover some of those lessons, hopefully, today, as always, on the show. We have a great guest today, by the way, Samantha LaDuc. I was excited to bring Samantha on as we're preparing for the Fed meeting tomorrow. Get some big picture takeaways. Tomorrow on Fed Day, we have Sam Stovall from CFRA Research joining us from New York. Next week, three solid guests. Mark Chaikin coming to us on Tuesday, the 27th. Ms. Schneider from Market Gauge on Wednesday. Greg Schnell from Osprey Strategic joining us on Thursday, the 29th. By the way, I was just talking with some of our ChartCon contributors earlier today. ChartCon 2022 is happening October 7th and 8th. Go to StockCharts.com/ChartCon. We had a call this morning to talk about the bull-bear debate panel. We have 8 different experts. Each of them will take one chart and argue one side, bullish or bearish. You will get to see 2 competing pitches for each of 4 major asset classes, and then vote. Which do you feel is more compelling? Which do you agree with, and why? Should be a lot of fun, and that's just one of the sessions we have going on during ChartCon. Go to StockCharts.com/ChartCon for more info on that event and to sign up. Members and those on a free trial get a special, deeply discounted rate. Let's continue on with our show today on the Final Bar. Let's talk about this market environment. Yesterday, a choppy environment, really pushing to the upside going into the closing around 3,900. We didn't see 3,900 today. We remained pretty, a little bit below there, finishing the day around 3,856 for the S&P 500. Let's look at all the charts together and see what we can learn about the longer-term picture given today's price action. S&P down 1.1%. As I mentioned, just below 3860 at the close. The Nasdaq down about 1% using the Nasdaq composite. Midcaps down the worst of the major indexes that we track, down about 1 2/3% to 2370. The VIX pushing back above 27, and that could be interesting as we go through the remainder of this week. We obviously have plenty of uncertainty with the Fed and what we may learn about their efforts to contain inflation tomorrow. Obviously, there's a lot that can be analyzed about the trends and momentum going into the Fed announcement, but certainly coming out of it. Elevated volatility has marked all the major bottoms in 2022, but it's gotten the VIX above 30 or 35 before it's usually been the end of that move. Are we looking at a higher fix going into the next low? And we have to wait for the VIX to get above 30? That's an open question for these markets that we'll probably be able to answer soon. 10-year yields, long bond yields, all moving higher, right? The 10-year yield almost to 360. Actually, it was just above 360 earlier in the day today. Closed today a little bit below there. Now, 3.5% was the high from earlier this year. 3.25% was the high from 2018. So we are, pun intended, in a bit of uncharted territory, moving to new highs here for the year. And I'm often asked, like, how high really could interest rates go? Theoretically, the answer is a lot higher. Now, is dramatically higher rates likely in the short term? I mean, probably not. But there's no reason just because we went to 360, that would be the end, right? The interest rates can certainly go much higher. And if you talk to someone who's been investing for a couple decades or more, they will tell you about extreme high interest rate environments. They have happened for sure. The dollar, by the way, is what we've often called the wrecking ball for risk assets, continues its long-term uptrend. We'll look at some charts of the dollar with my guest today, Samantha LaDuc. Interested to hear her take on that particular area of the market, with broad implications, obviously, for the macro environment. A lot of red on the charts of commodities. Interesting couple days for the DVC, closing near the highs of the day, but sort of opening lower both the last couple days. Sort of not much of a change from yesterday's session here. Gold and silver prices both down, along with crude oil prices as well. Cryptocurrencies, quite a mixed bag today, with Bitcoin and Ether prices both going lower. Bitcoin nearing that 19,000 level, actually chopped around there for much of the day today, and that's down about 2.5% from yesterday's close. Let's look at a chart of the S&P 500 here briefly and just see what we can see about the current environment. You know, in the last couple of weeks, we've been talking about the importance of the 3,900 level. We keep coming back to that. And I've often found that analyzing a particular chart, something like the S&P that I look at many times every day, it's all about lines in the sand, right? A level at which you would agree to change your thesis or revisit a position, you know, switch from more risk on to risk off, you know, really have a level, have a horizontal line that tells you, and we're okay as long as we remain above this point. If we break this, I need to revisit the thesis, right? Because it just might not be right. What's great about a platform like StockCharts, you can identify those levels, set price alerts. So have StockCharts text you or email you or pop up right on top of the screen and say, you have now reached the line in the sand. Go do what you said you would do. And you can't downplay the importance of alerts like that to help remind you when a key market has gotten to a key level. For me, that level has been 3,900 for a while. We first talked about that level back in May, because that was the closing low for the year going into May and early June. We then obviously undercut that, but then we've tested 39 a number of times from above, from below. And once again, it's in play here. Yesterday's high was almost to the penny right at 3,900. Actually, the close was right about there. Today, we're once again pushing back below that level. So how excited, how optimistic can we be about the S&P if we remain below 3,900? And my argument would be, not great, right? I mean, we can think about the long-term prospects. And I think if your runway is long enough, you'll probably look back at 2022 as providing a pretty decent buying opportunity at some point. My concern is, are there career-busting moves between this moment and where we end up down the road? And that's what the break of 3,900 tells me, is that there is a non-zero chance that we go dramatically lower. And this is where I'm starting to look back to 2018, 2008 and 9. And thinking about that sort of thing, to be, you know, where we're at in 2022 looks a lot like 2007, 2008, before we really got ugly after that. And so it's important to sort of compare where we're at right now to some of those previous cycles and see what similarities we can find. Now that we're below 3,900, I think that definitely opens the door to previous levels of support. We're very, very close now to the 38.2% retracement level of March 2020's low to January 2022's high. It's right around 38.15, 38.20. That was the low, the intraday low from May. That could come back into play certainly very, very soon. We're a rounding error away from that level. And below there, you're looking at the June lows, which is around 36.35, 36.40. We break below there. What's your next downside objective? If you don't have a good answer to that question, I would be thinking now, not that we necessarily are going to be there, but I would be thinking about those potential outcomes now, because then you're not surprised when the market actually does what you've laid out. I wanted to point out a couple other things here as we're looking at the dashboard. And as a reminder, I look at the dashboard frequently. I have this up on one of my monitors all day now. I would encourage you as a StockCharts member, if you are one, and you certainly should be, click on the gear icon in the upper right and make sure you add all these different customizations to this. This screen can become more and more customizable as you add some of this additional information. For example, these charts, these chart lists that I refer to all the time during the trading day. It's great to have them right front and center as I'm trying to make sense of these markets. By the way, we're in the process of adding a lot more cool capabilities to the dashboard. I can't tell you too much about them yet or demo them, but they are on the way. But a couple quick takeaways as I was glancing through this list. Today, on yet another down day, only one of the 8 phenomena stocks, what I would call those 8 sort of FANG and FANG-like names, only one of them positive today. Apple managing to go higher by about 1.5%, while the market itself was going down by about 1%. Most of the FANG stocks down through the course of the day. Now, is Apple a great chart yet? No, I would argue from a trend following perspective, because you have a couple good up days, but within the context of a pretty good long-term downtrend. We look at the chart of Apple, it's all about drawing trend lines. And if you draw a trend line just from the most recent highs, we're still below trend line resistance, right? It's encouraging to get a big move off of the low. I'm way more encouraged when I see follow through, when I see not just a bounce off a low, which can happen all the time in a bear market phase, right? You get those big quick reversals back to the upside. Get excited when we break above moving averages, break above trend lines. That's where I think Apple still has quite a bit to prove. But I can't help but notice nearing a new 12-month relative high. That's always an interesting pattern to detect. Also, just want to finish off by pointing out all 11 of the S&P sectors finishing in the red today. Consumer staples and technology, followed by energy, the top performers. Those are all down by less than 1%. Real estate, materials, and consumer discretionary leading the way to the downside. We need to take a quick commercial break. We'll be back with today's guest, Samantha LaDuc. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close for our show. A couple quick announcements before we bring on Samantha LaDuc, today's guest. First off, we welcome your questions. We're going to do a mailbag segment a little later in today's show. We'll do another one at the end of the week on Friday's show. We would love to feature one of your questions on the air. Our email is thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. We have so much great content every trading day. We have a fantastic group of contributors, many of which host weekly shows, come on as guests on the channel, and there's a lot of great expertise for free available at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Samantha LaDuc. Samantha's been a frequent guest on the show. I was really excited to bring her on this week during Fed Week. We have a lot to talk about. Samantha, it's great to see you and welcome back.
It's great to be here, Dave. Thanks for the invite.
Of course. So a lot of talking, a lot of debating about what we should expect from the Fed this week. Help us make sense of what the market has been telling us leading into this announcement. We're starting with the fixed income markets. What are you seeing here?
A great opportunity to rotate into fixed income. But before we get to that, this really is exciting because tomorrow the expectation that the Fed will hike by 75 basis points right now is being kind of front run with a potential 100 basis point hike, but I'm not seeing that. I definitely see the direction higher for longer. Every time we've talked, I have shown this chart of bonds, a 30-year, doesn't matter if it's 10, 5, 13 week, they just keep trending higher. And it's very much the mood of catching up to this rate hike regime, whether they talk about it or act on it. I definitely see this pace slowing in the future, but the direction is very clear. And just last year, Goldman, the sentiment was by the Fed, they wouldn't raise until 2024. Now Goldman is out today saying they won't cut until 2024. So sentiment changed quite considerably. And I think the amount will be 75. The direction will be up unless we crash. And that's a distinct possibility later on around midterms. But for right now, the duration is higher for longer.
It's a really interesting chart. And again, this long-term chart is just a beautiful illustration of the trend in the 30-year. Your second chart is looking at the TLT. What does this tell us about the shorter term environment?
So I have shown this 30-year bond price chart with you repeatedly over the past 2 years because I have been a huge inflationista and a rates bull and a dollar bull. These three macro trending trades have obviously continued. Now TLT I'm showing on a much smaller time frame, right? Which is I sent that to clients back in June saying 105 would be that short price target for a more sizable bounce if we get it. If we don't, all hell's going to break loose because stocks and bonds can sell off together. We've seen that where bonds have experienced their worst year in history. So this bounce level of 105 in TLT for a mini bond rally is important. And I have played that before, so it has worked for a very, very short duration trade. But more importantly, it really needs to. So we have basically a treasury rally, in my opinion, one way or the other after FOMC tomorrow for a short duration trade. But big picture, we are still in a heavy downtrend, as you can see from that 30-year bond price index, which is very much showing also in my indicators that we haven't even based in order to turn higher. So it's solid. And the other charts that I've shown when you've invited me on in this kind of macro bond backdrop is very much focused on the rate of change. And last time I actually spoke about how the rate of change in yields has been so incredibly sticky for the basically, summer of 2020, that this is a longer duration trade. It's a momentum burst that can last for a while. Not done.
Yeah, it's such a great chart. And at the bottom, you have Martin Pring's special K indicator. He actually just wrote an article earlier this week for StockCharts members talking about the weakness in bonds and how much that's related to the weakness we're seeing in equities. I think, mirroring very much the comments you made, Samantha. Now, talk us through the dollar, because I think, a lot of investors, particularly individual investors, understand the equity markets and ETFs to a degree, understand a little bit less about fixed income, but the dollar gets into this kind of murky, confusing area about what it means. What does it mean that the dollar has been moving up, and where do you see things from here?
That's the escape valve. So equities are not safe. Bonds have not been safe. Forget Bitcoin and speculative risk assets. Valuations obviously have come down. They have more to come to go. And most importantly, emerging markets, when they have this rate differential where the rate hike regime is so strong, fast and furious, especially in the US, they sell US treasuries and rotate into dollars. So this has been a very strong long since we spoke last summer. And we have come up to a little inflection point at that 110 before, usually they pause and digest before getting the energy to move higher. This is very indicative of risk off. Should dollars spike higher, as yields have very much stayed sticky against the backdrop of sticky inflation. And the major reason is wage inflation. Energy started the game, food, housing, but as a result, all combined, its wage demand growth has been extremely strong, and that is the enemy of bonds. In fact, I wrote about that in October of 2021. The deflation of wages ended with COVID. So now wages are outperforming productivity, which for decades had not been the case. And that is one of the major fundamental macro reasons for this continuation short in the bond trade. But having said that, we are at 105 TLT, which could very much indicate a mini bond rally. We are at 110 USD, which is, in the Dixie, a pause area. But again, above that, it will be more pain and suffering for equities.
That's a tough way to end the discussion, Samantha, but really well done. And thanks for tying all that together. This is an area that I feel like a lot of investors have so much to learn. And as always, you've given us a little mini masterclass in how to make sense of this. Samantha LaDuc from LaDuc Trading, thanks as always for joining us.
Thank you so much.
I love that discussion, by the way. That was Samantha LaDuc of LaDuc Trading. And if you hear about some of the ways she was describing it, if you picked up on how she was describing, the relationship of equities and bonds, we've had this scenario, right, in 2022 where you've seen weaker bond prices, right? One of the worst years in quite some time, and obviously a pretty weak equity tape as well. And that has happened before where you see weakness in both of them. But as she had mentioned, as I mentioned, Martin Pring wrote a really good article on that as well earlier this week. If you missed that, check that out as well. Really talked about that relationship and how until you see a rally in bonds, it's hard to imagine things dramatically improving. Great ad there, by the way, by Samantha, focusing on the dollar and that 110 level. I'll certainly be watching that one. Great take by Samantha LaDuc at LaDuc Trading. Let's continue on our show today with the Final Bar mailbag. As a reminder, the mailbag is always open. The Final Bar at StockCharts.com is the best way to get your questions to us. And let's get to question number one. Dave, you mentioned, quote unquote, the chart on your August 31st show. How can I recreate this chart? And thanks so much for asking about it. My market trend model is something I use often with my market misbehavior premium members. That's a core part of how we think about risk on versus risk off, and thinking about how to scale in and out of positions, and just trying to help think about more systematic ways of analyzing market trend as opposed to just subjectively analyzing a chart of the market environment. Well, the chart is one of the tools that I've talked about with a lot of our premium members. And it's funny, about maybe 2 or 3 times a year I will create a chart and just call it simply the chart. And what I like to do is take some of those key inputs and combine them into one visualization. So if I have nothing left, and this is the sort of if you're on a desert island, you're stranded on a desert island, what one chart would you have to make sense of what's going on? And I try to create a chart that combine those things. This is the chart that I created back in April. It has been a really good way to navigate this year because it addresses price trend, it addresses market breadth, it addresses offense versus defense, and then the relative strength of 2 key groups, utilities and semiconductors. And so far, depending on how you would describe these, you're certainly seeing strength in utilities, which is more of a negative sign for stocks. You're certainly seeing weakness in semiconductors. Others of these have been really helpful along the way in 2022, helping me think about that risk versus reward scenario. So how do you recreate a chart like this? Well, I'll tell you the way that you do it. And if you're watching this on our live stream or on demand, just hit pause and you can see the indicators that I'm using here. I'm basically using a chart of the S&P, and then an indicator called price allows you to bring in whatever you want. So I'm bringing in the advanced decline line for the New York Stock Exchange, and then a series of ratios. Offense versus defense using equal weighted consumer ETFs. The relative strength of utilities flipped over. So I basically do the SPY relative to the XLU, and then the relative strength of the semiconductors versus the SPY. This particular chart, by the way, is included in my Mindful Investor live chart list, which is a list of charts that I keep updated on StockCharts.com. To get to that list at any time, click on the Articles tab. You will see my blog is called The Mindful Investor. And at the very top, there's this gray button, Live Chart List. You can access the list of charts. I keep them updated with some notations. I try not to make it too noisy, but you can save the chart list to your own login, do whatever you want with those charts. So that's how you create it. That's how you can access a live version of it on our platform. Next question. On your market trend model, why is the first PPO called labeled long-term bear, and why does PPO 21340 stand for long-term? This is what I was talking about a little bit earlier when I mentioned my market trend model. This is a chart that I have running in the background. It's based on weekly data, and it basically mirrors the analysis I've been doing just individually looking at the chart multiple times a week. I found I was looking at a weekly chart of the S&P and trying to just make some basic assessments. What's the long-term, medium-term, and short-term trend? And I found using a series of exponential moving averages, I was able to systematize that model very easily. So while I do not run any money, or I wouldn't certainly recommend doing that based purely on a model like this, I found models are a really good input into my process. I like having something like this running in the background so I can always refer to the trend on different timeframes, then thinking about what the charts are telling me with that as the general backdrop. So when it's saying long-term bear, it's basically saying, this is getting to the second part of your question, the long-term model for me is simply the difference between the 21 and 34-week exponential moving averages. Those are the red and blue lines that you see on the chart at the top. The fact that the 21-day went below the 34-day back here in May confirmed the long-term trend to now be down for the first time since June of 2020. It has remained very much bearish in that period. And then the medium-term and short-term models are based on different exponential moving average calculations, all using weekly data. I update this every Friday on the close. And if you watch our show on Fridays, we will update you on the model. With my premium members over the weekend, we go into a little more detail about what that means for positioning. Next question. Today, you mentioned that you run scans for new 3-month highs and 3-month lows. Would you share these scan codes with us? So there is very little that I show on this show that I would not openly share with you. So you are welcome to ask. And most likely the answer is sure, because I have found one of the great things, one of the great ways I learned how to use StockCharts more capably, that's not a word, with more capabilities, was following people like Art Hill and Tom Bowley and Greg Schnell and Grayson Rose and just asking them how they set things up. I learned a ton by doing that. So I encourage you to do the same with me. So using the scanning engine, this is the screen that I look at all the time. And again, if you hit pause, you can review this some other time. But at the top, I'm basically saying it's a stock listed on one of these exchanges. At the bottom, I'm saying it's not an ETF because I just wanted to look at equities and I'm looking for a market cap above 5 billion. But this argument right here is what I'm using to look for new swing high. So I basically say the weekly close, whenever I run the scan, the current close is higher than last week's high, last week's 13-week max close, meaning this weekly close is higher than the last 13 weekly closes. Then it pops up on my screen. This gives me a little bit of room if there's some volatility, and I'm looking at weekly data, so I'm not looking too granular at one particular trading day. I'm looking more big picture. There are a number of other ways you can do this using daily data, using different arguments, but this is an easy way that I do that. And then you invert that and say weekly close less than last week's min 13 close, and that will give you the stocks making new 3-month lows, again, based on the weekly data. All you need to do is put a similar setup like this in your scanning engine, and you can scan and run that all the time. You can also do scheduled scans, by the way. So I have the StockCharts platform emailing me the results of those scans every day, and that is always a really helpful way of letting the StockCharts platform do the work for me. We need to wrap the show, folks, the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. And here is chart number 1. We're going to talk about the Nasdaq 100 bullish percent index. We haven't talked about this chart for a little while because it last gave us a key sell signal the second, third week in August. This is one of the great tells. If you go back over the last 6 or 7 months, every time in 2022, we've gone above 70% and then come back below. It has been essentially the major selling opportunities, I think, in 2022. We didn't quite get above 70% about a week ago. We're now below 30%, which means we're now starting to look a lot like some of the previous downtrends in this market. If you look at when we've dipped below 30%, that's not usually been at the bottom. That's been leading into the bottom. This is the beginning of the bottoming process that most likely still has a little bit further to go. I'm going to be updating this chart, but I would encourage you to watch the Nasdaq 100 bullish percent index to make sense of the current environment right around the Fed meeting this week. Chart number 2 is building on my great conversation there earlier with Samantha LaDuc. I love having Samantha on the show because she shares long-term charts that help put all of the noise, all of the busyness that we have, all the debates about the Fed and what it means, puts it into very clear trends, right? Really thinking about those relationships. When I'm looking at the U.S. dollar over the last year, I'm highlighting the fact that since June of 2021, the momentum has basically been in a very, very bullish range consistently. We've become overbought when the dollar's moved higher. We've not gotten below an RSI of 50 or 40. When we've pulled back, that is still very much in a constructive range. How strong can risk assets be when the dollar continues to move higher? The release valve for the markets, as Samantha LaDuc put it earlier. Finally, let's highlight some charts that are constructive. Somewhere at some point, there is a stock breaking out. Wynn is a stock I wanted to highlight today. One of the best performing S&P members today, close to making a buy signal using an inverted head and shoulders, but not quite there. You need to close above this neckline. Not quite there, but if we do, upside to the upper 90s potentially. Folks, that is a wrap for this show. Special thanks to Samantha LaDuc from LaDuc Trading. For StockCharts, I'm Dave Keller. Have a good night. We'll see you tomorrow.